Okay, cool. Yay. Awesome. Yeah, so I'm Kyla. I'm currently in Denver, Colorado, and here to talk about the Fed today. Anna, do you want to go next, and then we'll kind of go around?
Hi, I'm Anna, and I'm currently in Brooklyn, New York.
Kevin, do you want to go next? And then call in another person?
Hi, I'm Kevin, and I'm currently in Zurich, Switzerland.
Okay, Henry?
Hey, Henry Vasquez, Los Angeles. Jacob?
Hey, I'm also in Brooklyn right now. I'm like procrastinating on my job, which has a lot to do with the Federal Reserve, of working on financial regulation, to attend this talk instead. How about Wesley?
Hi, I'm Wes. I'm in Lexington, Massachusetts, site of the first shot of the American Revolutionary War. Sam, there are two of you in Sam's video.
Yeah, so hey everyone, I'm Sam, Itai. We both registered for this, so we're not cheating. And we are calling from FIDI in New York. Oh, I guess I'll popcorn it to Sergey.
Hi, my name is Sergey, and I'm in San Francisco, California. And I'll call on Alex.
Yeah, I'm Alex. I'm in London now, in the UK. Who else? Quinn?
Oh, hey, I'm Quinn. I'm actually very new to Internet Intellect, so I'm still kind of getting oriented to stuff. Are we going through just like random like intros and like popcorning? Okay, well, I'm New York based. I actually don't know who all has gone, so hopefully someone will be willing to volunteer to go next.
I'll go. I'm Jonathan. I'm in Madison, Wisconsin. And I have no idea who hasn't gone yet.
I think Bo and Eric, or just Bo, I guess.
I'm Bo from Culver City, California.
And I'm Eric. I'm near San Francisco, California.
Cool. I think, is that everybody? Yes. Okay, cool. Awesome. Well, so glad to have you all here today to talk about the Fed. As I said at the beginning, if you have any questions or comments or want to say anything, please do. And I'm going to have a little PowerPoint that I made just to like talk about this stuff. So I'm going to share it. Actually, sorry, hang on. It's like not a boring PowerPoint, so don't get bummed out. All right, let me know if you can see this. Can you see it?
Yep, we can see it. Or I can see it.
All right, awesome. Cool. So I'm gonna move the chat over here. Yeah. Will there be charts? Yes, probably. Okay. Oh, if there's more people in here that we're missing, I'm super sorry. You can introduce yourself after, but we're going to go ahead and get started to talk about the Fed. So what is the Federal Reserve? Today, I kind of wanted to talk about the Fed, the history of money, the history of the United States and banking, and then getting into what the Fed is doing now. So sort of making a full circle of like the beginning of time to the beginning of this country and now to where we are today. So it's going to be both a quantitative and qualitative analysis around that. So the Federal Reserve is one of the most important entities in the world, but a big question is why and how they became so important, right? Like they are literally dictating the lives of so many people right now, but why are they doing that and how did they get this power in the first place? And they kind of act like shadow puppets, right? Like a lot of people don't know that the Federal Reserve either exists or that they know that the Fed exists, but they don't really know the power that the Fed has over their lives, which is kind of concerning. So we're going to talk about all that today, and that is on there twice. But this slide right here talks about the economy, right? So like when we normally think about the economy, we normally can break it down into business cycles. So there's normally a peak and a trough. So a trough is going to be when the economy is going down, which is kind of what's happening right now. And a peak is going to be when it's going up, like it was during the pandemic and during the past couple of years. But really a better way to think about the economy is a roller coaster. So rather than just being these relatively smoothish cycles where it peaks and troughs and all that good stuff, it's better to think about it like roller coaster, where it can go in a big loop-de-loop, it can make zero sense, and you can have like a lot of whiplash turning around without even realizing what's going on. Somebody, can you go and mute? Sorry. just make sure that everybody's on mute. Yeah, so what does the Federal Reserve do? So the Fed conducts monetary policy. So that right there is Jerome Powell, and those essentially wavelengths coming out of his head are monetary policy. And they really do a lot of work around this business roller coaster concept. So these loop-de-loops that we experience in our everyday lives, the Fed is going to dictate a lot of those loop-de-loops with monetary policy. And that ends up setting the economic vibes, right? So like, how things are feeling for people is oftentimes dictated by what the Federal Reserve ends up doing, even though it's sort of this, path that doesn't make a whole lot of sense, but they're very, very connected. And so what has happened over the past couple of years? So this is a graph of the S&P 500, which is one of the biggest metrics that measures out the stock market, and it's the top 500 companies. And as you can see, it's gone up quite a bit since the pandemic, which happened in early 2020. And then over the past, 2-ish years or so, it had this massive run up, and now it's going back down. And if you look at what happened during that time frame, there was a lot of different things that happened. I don't know how many of you are familiar with crypto, but there are Bored Apes, yield farming, DeFi, DAOs, CryptoPunks, tokenomics. And then in the more stock market oriented world, there's GameStop, AMC, Melvin, Citadel, Robinhood. There was a multi-million-dollar deli that was essentially like a money laundering machine, Archegos, which now has blown up, Kathy Wood and Bill Ackman. So all this stuff happened during this 2-year time frame, and it was really difficult to even stop and reflect on what was happening. So a lot of people just got caught up in the momentum of what was happening in the market and not really paying attention to why things are happening. And now going back to that business roller coaster concept, we're kind of in the loop-de-loop where we had this huge run up, and now we're kind of right here, just going right back down. And nobody really knows what that next turn is going to be or where we're going to end up next. So what has happened? So like, why did all of that happen during the pandemic and during that, the literally what the heck time frame? A lot of people were at home. We had to be at home, right? Because we were in lockdown. So a lot of people had extra time. There was also gamification of the markets. So Robinhood, Coinbase to a certain extent, all of these things created a lot of fun around the markets. Wall Street Bets was a big component of that, where all of a sudden the market could be sort of seen like a casino, and it definitely was treated as such. There was also accessibility. So apps like Robinhood also gamified, but they did it. They create access for the everyday person to trade stocks in a way that had never been done before. So for me, I started trading when I was 18, and I had to open up like a TD Ameritrade account, and it was super difficult. I had no access like I do now with Robinhood, which a lot of people now have access to. And there was also a lot of extra money. So during the pandemic, people either got stimulus checks or they did save money, like excess savings really increased during the pandemic. So there was a lot of money, there was a lot of time, it was fun, and there was a lot of access. And so that ended up creating the perfect storm of this literally WTF scenario. So that is kind of what happened over the past couple years. And now if we want to zoom out even more, we can talk about what is money. So that is a really important thing to discuss, because a lot of people, I mean, every single person in the world uses it, right? But like, we don't kind of stop and think about what it actually means to have money, even though it's so important, and it's so important to us socially, et cetera, et cetera. So money is essentially a promise between you and a bank. So you give your money to the bank, and the bank will be like, don't worry, we'll give it back to you. We're kind of seeing this relationship play out full time or real time with crypto, where there's groups like Celsius that are blowing up, and this promise was broken. You thought they were a bank or someone that you could entrust your money with, and it was no longer the case. So your money is not really money with institutions like that. And money is 3 main things. So there's a question, so I'm going to hop on that really fast. What % of daily volume in Russell 2000 is small time / novice traders? I don't know the exact answer to that. It seems like Wesley does, and it's between 10 to 20%. That sounds about right. But what is money? So there's 3 different components of money. So the first component of money is a store of value. So it holds value. So you're going to have money like cash, US dollars, and that's going to be a store of value versus like something like corn, which can rot. If you try to take corn to the grocery store to like get more corn or to get a different good, they're going to be like, wow, this corn looks really bad because you carried it all the way here. Like, this is not money. And it's also a unit of account, so you can compare values of goods and services. So a computer is going to cost a lot more than a pencil, and you can tell because they require different amounts of money. It's also a medium of exchange, so it's accepted for goods and services at stores. So you can spend your money at the store, and they're not going to be like, go away, we don't take this. It's accepted there. So that is what it is. It's a medium of exchange, it's a store of value, and it's a unit of account. And so if you think about this business roller coaster, right, or the business roller coaster that we talked about a little bit earlier, money is essentially you buying access to this business roller coaster. It's enabling you to get on the ride. And this business roller coaster that happens here in the United States and it happens all over the world, essentially, creates this world of money that we exist in. Money is a core driver of how the world operates, for better or worse. And if you think about sort of the intangible aspect of money. Money is a commodified relationship, right? So it's the glue that holds, this is like very hand wavy woo woo, but like it's a commodified relationship. It's the glue that holds society together. Like if you look at countries that are going through protests or maybe different types of riots, a lot of times it's over either not access to food, not access to electricity, utilities, things like that, and having a mismatch between money and the demands that they have. So money is sort of a way to express trust. And the history of money. So money really began as like a credit system, and then it evolved into currency, and then it kind of evolved from there. Zooming forward many, many years, the United States went off the gold standard in the 1970s, and now we have this fiat-backed system that is essentially equivalent to the full faith and credit of the US government, right? So like money is intrinsically only worth what the US government is able to sort of insure it for, and it's really backed by like the military power, other things like that, the trust that people have within the US institution. It's also going back to these other points about store of value, unit of account, unit of exchange. It's really important that the US dollar kind of maintains all of those things as well, which it does. So money now, the world is primarily driven by consumer debt. So here in the United States, GDP is, which is the sort of the measure of the US economy, it's 70% of 70% of GDP is consumer spending. So 70% of the US economy is driven by consumer spending. A lot of consumer spending is financed by debt. Credit card growth has been astronomical since the pandemic happened. And then there's corporations that issue different types of bonds in order to finance their own their own paths. That's not the right word I was looking for, but like basically corporations issue debt in order to finance their everyday operations. And all of that piles into the US government, and the US government finances itself through US treasuries, and as well as taxpayer revenue, which comes from the consumer. So that is kind of how you can think about money now. It's a pretty much a debt-fueled system, for better or for worse. There's a lot of leverage in the system right now. Leverage loans are a big concern, I think, for a lot of people, and then just consumers and making sure that they don't get overextended as well. But that is sort of the core driver of our economy. So a lot of times institutions will incentivize people to take out debt, to spend more money, to keep the economy growing. There it is again. So that is what is going on with money. But if you think about the technical aspects of money, money is technically bank liabilities, bank credit, and bank deposits. So bank deposits, in the most boring way possible, are made when banks make loans. So liability is money borrowed, asset is the loan contract itself. So money is essentially an accounting entry to these banks. But what money actually is, if you get into like the hand wavy woo woo stuff, which is what I like to do, it's really about trust, it's really about social cohesion, and it's really about capital S society, right? So like the relationship that money creates between different institutions, between your boss and you, between you and like maybe a friend that you give some money to buy a car, all of that is going to be this trust, social cohesion, and the capital S society. So there's a couple of questions from people, so I'm gonna hop on that really fast. Well, okay, maybe we'll do questions at the end. So history of money in the United States. So in the 1700s, the United States was using European currency at the very beginning of the United States' journey to be a country, to using European currency and barter actually as a way to have a functioning economy. And then in 1775, they were like, that's so ridiculous. Like, why are we using European money? That's crazy. And they, the Continental Congress issued Continentals to help finance the Revolutionary War, which was backed by the anticipation of tax revenue. So actually what they were doing with Continentals back in the day is sort of how our money works now, right? So backed by this anticipation of the government being successful. And then in 1785, the Continental Congress adopted the dollar for the national currency. And then in 1790-ish, the Constitution was ratified. Really was 1789, but people were delaying, so it was a little confusing. And then the battle for banks, this was a pretty big deal at the beginning of the United States journey, because Alexander Hamilton was like, yes, I really think banks are awesome and good. And I think that we need things that are going to provide credit to the government and businesses, issue a national currency, and be a place for people to safely store money. And then Thomas Jefferson was like, that's gross and I hate that. The government should not be involved at all. That's way too centralized. And the government should not have anything to do with currency. And this is like a really simplified explanation, but that's kind of what happened. Was these two guys were like just button heads. Alexander Hamilton ended up winning. They created the first bank of the United States in 1791. And then in 1811, the first bank of the United States lost its charter. So they went back to states issuing their own currencies, which was just like a total nightmare. Because if you're trying to do business across state lines, or you're just trying to be like a functioning country, and it's sort of similar, I guess, like to Europe, right? When they didn't have the euro, it just became really messy. And so 1816, Second Bank of the United States was established because they were like, that was such a nightmare with states issuing all their own currency. And then Andrew Jackson in 1836, when the second bank was up again for reestablishment, he was like, absolutely not, like this is gross, like get rid of it. And the free banking era began with all these wildcat banks. And there was 8,000 state banks, each issuing their own notes, but it was super difficult for customers to do what they needed to do at those banks, which was banking, because all of a sudden you had like 8,000 little monies floating around. So it's really difficult for you to maintain any sort of normalcy with that going on. And so, and then in 1863, the National Banking Act was established, which created a uniform national currency and only allowed nationally chartered banks to issue banknotes. So they were like, no more Wild West of money, which I think was a good thing to do. But basically what ended up happening here is like there's just a bunch of bank runs. The country became super industrialized and urban, and there was a need for a central bank or some sort of structure, some sort of normalcy. Bank runs kept on happening, like I just said, and that really wrecked the trust and growth that could occur, because, you know, if you're trying to build a company, or if you're trying to grow your company within state lines, and all of a sudden there's a big bank run, you know, you're just like, this kind of sucks, and I'm not super happy about this right now. And so then JP Morgan of JP Morgan came along, and he bailed out all the banks when a big bank run happened in the panic of 1907. And he was like, okay, everybody, like we need to sit down and get this really figured out, because it's ridiculous. And he was like, I can't keep on, you know, bailing people out. We need a centralized entity to take care of this. And so they all met up, him and a bunch of other rich guys, they all met up. And in 1913, the Federal Reserve Act was passed, and that was supposed to be this big solution to the volatility that was plaguing, you know, the country, and supposed to help them grow as they continued to industrialize. And now we have the 12 Federal Reserve banks in their districts, and we have the FOMC. So the Federal Reserve System has really grown a lot since the 1913 Act. But after the 1913 Act happened, there was a war. The World War happened like literally right after that. And so that really gave the United States a chance to really test the limits of the central bank that they just established. Because, you know, Europe used to be really big and in charge, but now the United States was like, oh no, we can help people, you know, finance a war. Like, look at us, we're gonna step up. And so dollar became really big in demand. Then in 1929, the Great Depression happened, and that sort of was a mess, but it was good to have a central bank during that time. And then the Banking Acts of 1933 and 1935 gave more power to the Federal Reserve and established FOMC, which is the arm that sets monetary policy. They established that during that time as well. It's kind of a funny story on how they like discovered monetary policy, because essentially they were buying and selling securities, and they realized they realized that influenced interest rates. So they're able to, you know, be like, okay, well, why don't we just keep on doing that? And that will be the way that we, you know, manage the economy from here. So that was really the beginning of the Federal Reserve. And now they have all these different tools in their toolkit to help manage monetary policy. So basically the thing is here is their main goal is to get people to, and this is present day, their main goal is to get people to spend and produce more or less. So right now they're definitely in the camp of like wanting people to spend or produce less. They're in quantitative tightening versus quantitative easing. And the way that they have their different toolkits is discount rates. So basically they nudge around the discount rate. And the whole goal there is to make banks, you know, lend out more or less. Open market operations, a similar goal. make banks lend out more or less, reserve requirements make banks lend out more or less. And all of that sort of does is influence the Fed funds rate. And that is sort of like this key interest rate in the economy that ends up nudging all the other rates like mortgage rates, et cetera. So that is really the big thing, is they do all these different things in order to influence the Fed funds rate. There's that component of it, so the quantitative component of their monetary policy, and there's the more, excuse me, the more qualitative component. And so I don't know if you all pay attention to how often they come out and speak, but like they come out and speak, one of the members of the Fed comes out and speak about once a day now. And the whole goal there is to sort of influence how people are feeling based on the data that they're getting real time. And so that is a really big component of how they're managing monetary policy now, just because the discount rate was, or because the Fed funds rate was so low, now they're really using their credibility part of their toolkit to influence this. So this goes back a little bit in time, but basically the Federal Reserve Reform Act was established in 1977. And this was the last big time that we had a huge energy crisis was in the 1970s. And so they were like, we really need to make sure that the Fed is able to maintain some element of price stability. So their price stability mandate was established in 1977. In 1978, the Full Employment and Balanced Growth Act established their mandate of full employment. And that sort of brought their dual mandate together. Now they have a mandate of maximum employment, which is sort of like, we need diversity in the workforce. We need to make sure that everybody is employed. So it's a little bit more expansive than full employment was. But basically what this did was, the reason I have like these Pokemon guys on here is because this gave the Fed a lot of level ups. So like their power and influence just really was growing over the past 100 years since they've been established, right? And their power and influence just kept on growing and growing. And now there is a lot of argument to be made around them being like one of the most important entities in the world, just from the way that they are able to move markets and sort of set the precedent for the economy. Sorry, I'm talking a lot of it. So 2008, so this was a really bad time, right? Obviously, people lost their jobs, their homes, and the banks got billions of dollars in bailouts. And I said seems balanced there because it did seem a little bit one-sided in terms of favorism towards the banks. But essentially what happened here is the banks were like, everybody gets a mortgage, no worries, like everybody should qualify for that. And that really was not good, because you had a lot of borrowers who maybe weren't able to afford that mortgage, and it kind of created this ecosystem that was a little bit toxic. And then they ended up packaging all those securities together, even the ones that were not good. And so like if one thing blew up, like the whole thing's going to blow up. So like it's the metaphor, one bad apple ruins the whole batch, right? And so that is essentially the most simplified explanation in the world of what happened in 2008. But that's one way to think about it, is like, you know, you had the banks, you had them doing all this stuff. During that time, the Fed set out on this massive QE program to try and, you know, save the economy. And one could argue that we have never really left, you know, that era of really easy money. We've definitely tried a couple of times, like in 2018, but the market just has not accepted that from happening. And so that is a really interesting thing to think about as we go into this quantitative tightening path that we're on now, where the Fed could potentially raise by 100 basis points at their next meeting. It could be really interesting to see like how the market does respond, especially considering that it has not really allowed any movement in this for the past, you know, what is that, 14 years? So that is one thing to keep in mind. And essentially what happened here, it was a lot of contagion in 2008. One could argue there's an element of contagion now. A good way, if you're familiar with the crypto market, a good way to think about 2008, or a good way to think about the crypto market now, and vice versa, is that contagion, that domino element where everybody's exposed to everybody. So for crypto, like Three Arrows Capital blew up, and now you're seeing all these other guys blow up. Same thing here. One guy blows up, the whole thing blows up. So now, like I said earlier, the world is financed by debt at a global level. You know, I think the debt to GDP ratio for the world is like 300%. So there's way more debt than they're able to really finance through their own economies. And the question now is, how much should we consume versus how much should we go after sustainable growth? Like there's a lot of argument for degrowth. There's a lot of argument for almost an element of stagnation where we're not always chasing after this next big thing, because you have the worries of the climate crisis, you have the worries of what it means to keep on growing in a way that's unsustainable for the people around us. Like, how does that impact wages? How does that impact what corporations do? Who's going to take care of the ghost corporations once they blow up if you're always chasing after that element of growth? So these are really the big questions that the world is, I guess, exploring right now. It's just something that I think a lot of people are thinking about for the world. But yeah, so the safe haven USD, the dollar. So this is an interesting component to what I was just saying about, like, consumption, world debt, all this stuff. The dollar is, a lot of people are like, the dollar is not going to be the reserve currency of the world anymore. And the IMF wrote a paper about this, and you are seeing people rotate away from the dollar, but they're rotating into smaller currencies. So it's not really like everybody's going into one big currency, like China's currency or Russia's currency. It's people just going into a diversified basket of currencies. So we're starting to see this economic fragmentation happening. And that is a little bit concerning. The Fed is largely in control of like what is happening to the dollar to a certain extent. So as the Fed continues on this tightening path, that is going to push the dollar up in value, which is why it's a safe haven. But also because people are like, oh man, like they're raising rates over in the United States, that's going to be higher yields, that's going to be a little bit better for us. So we're going to demand dollars so we can go into US assets. But also it's a safe haven. So it's a way for people to avoid volatility. So if you think about it not being the reserve currency anymore, that's not really a plausible argument, just because it is still serving as the safe haven basket. And then inflation, right? So like this is definitely top of mind. 2 days ago, yesterday, the inflation print came out and it was really high. It was 9.1%, which is super, super high. For context, the Fed normally targets a 2% inflation metric. And so now we're getting this 9.1% print. And that's a little bit concerning, to say the least, especially because people were really hoping that inflation had peaked. There's actually two different metrics of inflation though. So we had the CPI print yesterday. The Fed actually looks at PCE, and there's two different ways to calculate those two things, and they're using two different economics equations. But basically, as you can see, the CPI has a much higher weight towards housing. And so we've seen just massive increases in rent prices and home prices over the past couple months, and that is a huge component of CPI. However, energy, which is not on this graph, but energy is a huge component of CPI, and that drove 50% of the increase yesterday. And so basically, there's a little bit of difference in these two metrics. The PCE is actually printing lower than the CPI right now, but basically the Fed is going to look at both. The divergence in them, I said on this page, the divergence in attention could lead to divergence in expectations, but now the Fed seems to be taking into account like literally everything. So I don't think that'll really happen. But yeah, this is going back to the Fed's toolkit, right, of how they control demand versus supply. This is not good for them. So like housing being a big driver of inflation, energy being a big driver of inflation, they cannot go and print more oil. They cannot go print more houses. All they can really do is make people stop demanding oil or make people stop demanding houses. And that is a little bit difficult because we're going into this slowing economy. So if the Fed is essentially like, everybody stop it right now, stop demanding things, cut it out right now, that's not really great, right? Because we really just need more supply. We already have people, demand's already slowing down to a certain extent. So the Fed slowing down demand even more and not fixing the supply function is not the best thing. The supply function has to be fixed through things like fiscal policy though. So that's a whole separate function than what the Fed can actually do. And so this gets into inflation expectations. So Jeremy Budd, who used to work at the Fed, but he wrote this paper called "Why Do We Think That Inflation Expectations Matter for Inflation?" And this is something I have a newsletter called kyla.substack.com, and I write about this all the time. And basically it's all about expectations. It's all about what people are manifesting, which is, I know, not a popular word to say, but manifesting into existence. So what people expect out of inflation is sort of what we end up seeing to a certain extent as well, especially when we think about the functioning of the economy and how we're, are we in a recession or not. A lot of that does come from consumer sentiment, and consumer sentiment, as I said, or consumer sentiment is a huge driver of consumer spending, and consumer spending, as I said earlier, is a huge driver of GDP. And so if you think about that relationship, so expectations driving sentiment, which drives spending, which drives GDP, all of that is interrelated, and that could really harm economic growth, going back to that expectations theory right there. And so basically that Bullard is saying that we really need to, or Bullard, Rudd is saying in this paper is that we really need to make sure that people are not freaking out about inflation. This is written back in 2021, so a little bit foresight 2020, I guess, but definitely it's something to keep in mind as well. It's just like how people are feeling is very, very important to how the economy functions. And then what the Fed looks at. So like, okay, whoa, the economy feels bad, right? But like, how do we know what's going on, like how it feels? So these are just two things right here, two measures of that. So financial conditions. So bonds, as I said earlier, companies issue bonds when they're trying to finance different things. So just like people take out loans to buy cars, like companies are going to take out or issue bonds in order to, finance something. And so the spreads on bonds, which how can I explain this? But like basically how bonds are trading is really indicative of how the market is feeling. So if all of a sudden bonds start trading at like in a really wacky way where the spreads are really wide, that means that people are not feeling good and they're not willing to take on this company issued debt, right? They're like, that's gross, I'm not interested. There's also housing. So when the Fed funds rate gets nudged around, that does impact mortgage rates. So right now, 50% of the increase in home prices is as a result of the shift to remote work, which is really high. We're starting to see some recovery and inventory levels, especially recently, but homes are still really, really expensive for the average person. And part of that problem is because there's just like no homes. There's just not a lot of supply in the places that people want to live, which is a little bit different than having supply in places that people don't want to live, of course. And so the Fed pays attention to, spreads on bonds, and they pay attention to the housing market. They pay attention to the stock market. They pay attention to gas prices. They pay attention to all these different things in order to help them make those monetary policy decisions. So these are my final two slides, and then I know that the chat has been going, but we can go into questions after that. But like basically our discussion. So there's Fed action as well. So I wrote a newsletter about this today, actually, and I think that the way that you can sort of think about the vibes being set in the economy is inflation is really, really a big driver of how people are feeling. Like it really is the worst to go to the grocery store and be like, man, I literally paid, $40 last week and now I'm paying $60 for the same exact basket of goods. Like that is just not a good feeling. And a lot of people are feeling that, of course. And a big driver that is energy prices, which are starting to come back down, shelter, rent prices, food, all that stuff is going into this inflation metric. And the Fed is in charge of managing inflation, as we talked about, like a dual mandate that they have. So they are going to manage inflation through monetary policy. And the thing that is, the Fed has other pillars to them other than that. So they have Fed action, which is their toolkit, and that is ultimately monetary policy, where they end up destroying demand. That's what they do. But what we need from them and from the world is managing supply, right? Like they're using a hammer and we need this power saw thing. And that is a huge mismatch in what we're able to accomplish. Like we can destroy demand all we want, but if we really need energy, if we really need oil, like that is a whole different situation. There's also Fed liquidity. So if you think about financial functioning of these countries, of these corporations, if all of a sudden, the Fed is a huge component of the bond market. So the Fed owns about 25% of mortgage-backed securities. I think it's about 30% of agency-backed securities. And essentially what that means is they do own huge components of the credit market. And that is super worrying as the Fed begins to pull out of this, as they do quantitative tightening, which means that they're going to sell off their balance sheet. That is super worrying for how the functioning is going to continue, because essentially you're going to have other people, go and buy up all that debt. And that means that that debt is at a higher risk for contagion if one of those guys goes under. It's the same thing with countries. So Japan is a huge, like, what the heck is going on there? That's a huge problem for the United States and vice versa, because Japan is a huge buyer of US treasuries. They're facing their own inflationary problems, and they're in this world of like just mega quantitative easing. And the yen has, gone down quite a bit over the past year. There's also Fed credibility. So if you think about jobs and prices, a lot of those are set by businesses, and businesses kind of pay attention to what the Fed is saying, but it's really, once again, those vibes. If businesses right now are hiring people. Like there's still a lot of plans for hiring. The Fed released their Beige Book, which is the regional analysis of different corporations and talking to different people across the country in those 12 regional districts. And people are still like, yeah, we're going to hire, but like, man, our price is going up. So companies are going to begin to raise prices. And as they do that, that sort of creates a little bit of problem. And so that is the whole thing. And there's you. And then there's this concept of the vibe session. So I also wrote a newsletter about this. I'm not just like pumping my newsletter. I think these are like kind of things that are happening. But essentially what the vibe session is, there's policy, so monetary and fiscal policy, and that ends up dictating to a certain extent, like oil, manufacturing, raw materials. And what those things end up dictating is like gasoline prices, housing, labor market. And that ends up creating this element of reality, right? Like we all exist in some thread of reality, believe it or not. And that reality ends up shaping the vibes depending on, discourse that we receive, depending on how we interpret the narrative that we're receiving. And all of that stuff goes and feeds into this narrative / model that we develop. So we have our experience and our evidence. So experience would be like, if you lived through 2008 and you like lost your job, like all of a sudden you're probably going to be a little bit more risk averse. Evidence, you're looking around right now and you're like, man, this is just like 2008. Oh my gosh, it's going to happen again. And that ends up shaping your expectations, that ends up shaping your perception, and that ends up shaping your interpretation of the world around you. And that creates sort of the consumer, right? So this you probably as a consumer, multiply that by everybody else, that's consumer sentiment, and that drives consumer spending, that drives GDP. And that is what the Fed is paying attention to, is like all this stuff to a certain extent, not really vibes, but like sort of. So yeah, that is everything. So thanks. I'm gonna stop sharing my screen and then, sorry, I was like totally talking super fast, but I don't know how to begin with questions. I guess, would it be easiest if people just like raised their hand, came off mute?
First of all, this was an incredible amount of information. Wow. I mean, I'm not surprised knowing your work, but I'm like, wow, yes. I'm so happy this is being recorded because we can like watch it a few times. I would probably just like ask people to raise their hands just so that you can like create the order between people you want. Or just, you can also just go through the questions in the chat.
Yeah, Wesley has a question, so go ahead.
Thanks for the whirlwind presentation. I've kind of a wacky, I shouldn't say wacky, an intriguing question. I only came across this recently. It's an argument that the U.S. government's ability to essentially issue as much debt as they want and inflate it all away by increasing the monetary supply is a major driver of basically the world's worst conflicts, right? Like we would not have been able to really finance a lot of the wars that we're in without that kind of ability. What do people think about this idea?
That was an idea that was popular back in the 60s during the Vietnam War. And I think economists have sort of tied that particular fiscal expansion to the rapid inflation of the late 60s, early 70s. So if I understand your question, can you restate your question once more? So government financing of wars is
so right. So the government can essentially take on a bunch of debt to finance a war and then inflate all of that debt away, as opposed to like, say the government were like on the gold standard or something, right? And it took on the debt, they wouldn't be able to increase the amount of gold. The government would actually have to like pay back that debt from some kind of revenue.
Okay,
right?
so you're talking more what they call the MMT, modern monetary theory.
Yeah, like maybe even more loosely, just like like fiat currency, right? Just the ability to like change the number of dollars in the system, like allows us to essentially.
It doesn't have to be war. You can see it as like, I don't know, just like a major component of US GDP. Is like, we're gonna print dollar and we're gonna get other people around the world to give us stuff for, treasuries or other like dollar equivalents. And then, I mean, you can use it to pay for wars. You can just, like hand it out to people who, I don't know, like basically hand it out to people who own stocks. And it's just like a tax on basically everyone in the world who, isn't the US prime broker or a US asset holder. And like as long as it keeps going.
I mean, Lockheed Martin is a public stock, right, Kyla? Like you can track it with like the portfolio of stocks that are all linked to US government spending, and they do go up with wars, understandably, because there's more money, they create more debt, and then like they fund these companies which are government contract fueled. Like you can also track government contracts and the creation of private companies in the space too as a proxy for this if you really wanted to get data driven on it.
Yeah, I think it's also not necessarily super new. It was actually fairly common in the past for governments to temporarily suspend the gold standard during war so they could issue more debt and raise money to fund them.
So you'd want to be in the gold standard if you're like one among a lot of other countries, and whether they're going to like buy your debt depends on some sort of like faith in you. But if you're like the only global superpower, it doesn't make sense for you to tie yourself down to a gold debt. So I sent the links to a chart. I think the place that I've seen kind of arguing for how much of the US economy is really just inflation is if you look at the total net worth of US households, which is like in the chart that I just linked in the chat. So you can see that, I don't know, like in 1956, it was like roughly 1% of what it is today. So it grew like 100x in the last 65 years. You can kind of look around and you're like, do we have 100 times as much stuff? Like, is all the stuff that we have 100 times as valuable as it was in 1956? And if the answer is no, then like the entire gap is inflation. And this is kind of like the purest way to measure it. Or not like to measure it, but like to get a sense of it, right? Because like CPI and stuff, you can kind of like play around with them. But if you're saying, I think we have like 5 times as much stuff, like everything we have is 5 times as valuable as in the 50s, right? Like our iPhones are that much better than whatever they had, then it means like inflation was 20x to make up for this 100x increase. So that's kind of like a way to think of it. I don't know what thoughts people have if they look at this chart of nominal household worth.
What's the distinction between nominal household worth and real household worth?
Well, because real means like somebody came up with some sort of like deflator, right?
Mm-hmm.
But that's kind of the question here is like, what should the number be? Who decides on it, right? I mean, like the Bureau of Labor Statistics and stuff, or no, who publishes the inflation. Now they can come up with various inflation numbers. Other people can disagree with them. But you can kind of look at just the nominal numbers and then try to like get a sense. How much is better the real stuff, and then inflation is the rest, as opposed to tracking inflation year by year.
Thanks, Jacob. I do want to like make sure we have time for more questions. So that is a good conversation, but I do want to make sure, Jonathan, do you want to ask your question?
Yeah, I've got a very non-technical question. Your concept of the thing that the Fed does is influence people's expectations. And that very much maps with what I learned in AP macroeconomics. I'm curious if you have thoughts, Kyla, on how easy or harder it's gotten to do that now that all of our attention spans are so fractured. And I wonder whether that just makes the roller coaster go faster or up and down 10 times as often, or impossible to manage, or just more manic, or do we just need to invade a small country and everybody feels good about ourselves for a little while? I'm not suggesting that, but what is it? Is it merely a matter of distraction, or how do you think that interacts with the social media era?
Yeah, so I actually wrote about this today in my newsletter. So very much top of mind. I think that it's made it even more confusing, and other people can hop in if they have opinions as well. But like, I do think social media has totally skewed how we think about things. I think it's made us more nihilistic. I think it's made us more concerned. And I think it's really like messed up the data points that we have in our head. A lot of times when the Fed comes out and talks about things, like people don't really have a framework for what that means. So they're like, today, people were like 100 basis points, and it's like, what does that actually mean? And so I think that's part of the problem is social media just continues to like drive of these confusing narratives, and we never really get a break from that news cycle. So when you think about it shaping expectations, a lot of times it just shapes them in a more negative way because social media trends negative. So yeah, I don't know if anybody else has thoughts on that, or we can go to the next question.
Well, so in social media, there's like a lot of competing narratives, right? People come up with their stories, what's happening, there is inflation, there isn't transitory, there isn't, is there stagnation? Oh, so before there were like fewer stories, like, I don't know, maybe like all the newspapers and all the TV kind of agreed with all the like top economists at all the prestigious universities. So there was only like kind of like one common story and there wasn't as much whiplash. But like, was that story necessarily more correct? Because see right now, people just like shit posting about inflation. They don't really have like a dog in the fight. Right? Probably don't stand to make or lose a lot of money or prestige or a job, based on kind of shape and sentiment one way or another. And I was wary of the idea that like just because like people are fighting more, there's like more stories and people making up shit, that necessarily they're like more wrong than when there were fewer opinions.
Yeah, awesome. Thanks, Jacob. Does anybody else have thoughts, or we can go to the next question? Cool. John, what's your question?
Yeah, so my question is basically, if you look at the kind of architecture of the domestic financial system in the US, which is relatively similar as far as I know, and I'm not expert in this across other kind of modern economies, is that the central banks have limited levers. They have base rates and they have issuing bonds or whatever, and then they have leverage ratios and stuff like that. If you look at those like structural features of the financial system, realistically, is it going to reform itself, right? Are going to be any like transformations in the financial system as conventionally established in modern economies on the horizon that are realistic without fiat currencies collapsing? And then you can kind of segue that maybe into what will the financial governance system do with crypto? Will it absorb it, central bank digital currencies? Like just kind of maybe comment on the baseline governance like evolution question for an idiot like me, and maybe see if you can like wine a bit of crypto governance into that if you can for an idiot.
So just so I understand, you're asking like if the system will essentially correct itself. Is that right?
More like governance reform. Like how should this? I mean, you described the history, right, of how these various instruments came to be and how money came to be stable and central banks stuff. What is the future of the history of the financial governance system of the US or a stable economy? And does it include absorbing crypto, rejecting crypto, right?
Yeah. Somebody came out, I think it was Waller or Bullard, basically was like, yeah, DeFi is going to be a bigger component of the US, or not the US, but like financial systems in general. So I think like there's two threads there, right? Like there's the part of like, what is the future of the financial system? I do think it's CBDCs. So I think that the central bank digital currencies are going to be a big component of that, and how we're able to, that's going to mean like a lot of different things, both in terms of the ease of spending money, but then also the data that the government will have on different people and how they sort of build out systems from that. So I think CBDCs are going to be a big deal. I think that essentially, like, my theory is that USDC is going to be the model for that, because BlackRock's invested in that. And I think Larry Fink is a sneaky guy who sort of knows what's going to work and what won't. So that's sort of my theory around crypto. And stablecoins is going to be USDC.
That's what Balaji says as well. You know that.
Oh,
Balaji things.
That's also something, yeah. But I think that that makes a lot of sense why he would think that. Yeah, so I think that's sort of the theory there, is like CBDCs will tick up. I think that we're going to have different monetary policy tools. I think that the Fed is going to continue to run into the wall with the using interest rates as a lever. Like, that's just not going to work. It's not really working right now to a certain extent. So I think that you're going to have to see fiscal and monetary policy become more complementary than they've been. Also, sorry if I'm like saying words wrong, but like I think they're going to have to be more work together than they have been previously. So that's my theory. Yeah. Did that answer your question?
Yeah, sort of. I mean, I mean, I was kind of hoping you would like give me an example of a new kind of instrument or a new kind of harmonization measure between fiscal and monetary policy, like put your cards on the table for what's going to happen in terms of like financial systems governance in the next 10, 20 years. But that's maybe for another session. I think you've got more of this coming up. So I'll ask the same question again and again and again.
That's like
in the future.
That's like a research paper. I'd have to write. But that's definitely a good question and something to think about. Bo, do you have a question?
Yeah, I was curious. So I see mortgage rates are X%, interest rates on bonds are X%, savings accounts are X. When the Fed increases or decreases their interest rate, how does it actually affect these different types of interest rates?
Yeah.
Where does the calculation and the amount they increase come from?
Yeah, somebody might have a better answer than I do on this, but like essentially it's nudge nudge. So it's kind of like domino tipping. So like if you think about the Fed funds rate, that's going to essentially influence how banks lend, and that's going to influence how they lend out to the broader economy. I don't know. So please somebody else hop in if there is a more concrete answer, but I don't know if there's a one-to-one relationship because mortgage rates just kind of, I mean, they've been going down, so they shouldn't be doing that considering what happened to Fed funds. But yeah. Does anybody have a?
Yeah, I believe that the short answer is that when the Fed buys bonds to adjust the federal funds rate, that affects the cost of borrowing money for banks to borrow money from the Fed itself. So that increases the liability costs for the banks. So when they go out and make their loans, they have to do the adjustment on their own balance sheets in the aggregate in order to afford and doing business essentially. So that has a sort of knockoff effect on the loans that banks then give out. And that gets into the questions about money supply and basically how you calculate the cost of holding money in reserves versus lending out. So then I believe that's a short answer, but there's been a lot of details that have changed in the past, like since 2008, and the new tools that the Fed has added.
So it doesn't seem like there's a concrete answer to that at the moment.
Yeah. Well, I mean, the rule of thumb is that if the Fed adjusts the federal funds rate, then that affects the cost of doing business and for the banks to loan money from the Fed in order to loan out to their customers, et cetera.
Yep. Yeah, it does.
So,
yeah. Cool. Thanks, Jared. And thanks, Bo. Sorry that there's not a more concrete answer to that. Jen?
Hi, Kyla. So I'm a former futurist turned fintech entrepreneur. And so one of my current queries / concerns is the amount of money in private markets. So as you said for this, like people are the economy, right? But yet over the past 10 years, so much of money has moved into increasingly private hands. So much of assets, like especially in those baskets of goods, have moved into increasingly private and hands. So like, how do you see that evolution of the private market on kind of the wider economy? Like what's sort of some of your thoughts on that flow of dollars into more things that, you know, federal policy may only influence or centralized bank may only influence like very tangentially or not at all?
Yeah, I mean, I think like watching what's happening in private equity and how they're buying up homes is a little bit concerning. And I know that's not like a huge portion of the market, but I think that's definitely something to watch out for is like as investors treat everything as an investable asset that does price the person who's not an investor out of that. And it changes incentives. So people are like, oh, I want this number to go up. And so I think that's of big concern. And then also like, this is sort of a fluffy answer, but I'm a little bit worried just in general, like how private markets allocate money. Like obviously their main goal is an exit. And what that ends up doing is skewing incentives towards companies that are going to have a high exit, do well at IPO, et cetera. And so those aren't always going to be companies that are net good for society. They're going to be companies that are able to take in more money. So I think you see an underfunding of companies that we desperately need to fund, like in the healthcare space, like bioscience, like different things like that. Education, I think also is concerning. So I would say like that's a worry, but like if your question is more around them being isolated from the Fed. I actually made a short video about this a while ago, where, you know, if you think about what's happened over the past 2 years, venture money did influence a lot of what we saw, especially in crypto. So I think there is a level of responsibility that these allocators oftentimes don't have to respond to, because that's all they really are, is, you know, allocators to a certain extent. So I think there should be like a little bit more incentive alignment between them and broader society, and just like this, like even this is like a goofy take probably, but like even more of a question around what does it mean to have the huge responsibility of funding the future and doing that in a way that serves everybody versus their own portfolio. Yeah, did I answer your question?
Yes, I could probably go more into it though. That's a good enough starting place.
Okay, yeah.
Else ask it.
I'm not super knowledgeable in private markets, so that might have been the worst take ever. But yeah, so we are, oh my gosh, we're almost at time. So I don't want anybody to miss their next meeting if they have one. But I really appreciate everybody hanging out. Anna, are there any other things that we need to do before we log off?
This is amazing. This is the shortest, densest, most brilliant salon I think that we've ever done. Amazing.
Awesome.
Yeah, so maybe you just want to say a couple of words about, like, this is the kickoff of a new series. So what folks should, expect, what should we be reading until the next session, and what the cadence is, any plans you have?
Yeah, no, I think it's about once a month. So this time in August, which doesn't feel real. That's insane that that's so close. It'll probably be a topic that's similar to this, maybe a little bit more around a more specific economic theory versus like what I did today, which is jumping around. So keep your eyes out for that. But yeah, I'm on socials at Kyla Scan also. So if you have questions, I'm happy to take them there. There is not a Discord. Sorry. Those are so hard to manage, so I stay away from them. But yeah, you all have a Discord. So just kidding. You can manage it. I cannot. So that's good.
We'll make sure that if you send me the slides or anybody on in the Interact team, we will just like get somebody to put it on the Discord.
Yeah. Awesome. Well, yeah, thanks so much, everybody. And hopefully I'll see you back next month.
Thank you so much. And congratulations, Kyla. See you guys soon.
Yeah, thank you. Bye.
Thanks, Kyla. Bye, everyone.